Welcome, everyone. My name is Drew Coleman. I'm a financial advisor with the Next Level Planning Group. Welcome to session 7 of our new 10 for 10 series. The idea of the 10 for 10 series is to do a deep dive, spending roughly 10 minutes covering one topic. At our last session, session 6, we covered 3 strategies around how to minimize the impact of capital gains tax. And today we're going to continue that conversation and cover the next 2 strategies of how to minimize the impact of capital gains tax. Welcome to session 7, part 2. But first, I'm going to share with you a few disclosure slides. And if you recall, in the last session, session 6, we covered 3 strategies. Number 1, gifting to someone in the 0% capital gains tax bracket. Number 2, keep that appreciated stock throughout your entire life and then leave it for your children or your heirs. And number 3, employ tax loss harvesting strategies. Today, we're going to focus on the next 2. Strategy number 4, to donate the stock or the fund. And number 5, to fund a donor advised fund. For both of these strategies, and in fact, for all the strategies that we've covered, it's important to coordinate them with your tax advisors to ensure proper implementation. So let's get into the first strategy, donating the stock or the fund. Now, it's fair to say that you can always just simply write a check. You can always write a check to make a donation. But if you're charitably minded and you have assets that have appreciated in value inside of your non-retirement account, this could be a more effective way to make a donation. Because if you sold that asset and their gains, you'd incur those capital gains tax and the burden of paying the capital gains tax. But if instead you gifted that appreciated asset, that appreciated stock or the fund, and you gave it to a charitable organization, because they are a 501c3 entity, they don't pay taxes. And then they can sell the appreciated asset and get the full benefit of that full amount. For example, let's say you wanted to make a $2,000 donation to an organization of your choice. Well, like I said, you could always just write that $2,000 check. But alternatively, you could look at your stock portfolio, and you might find that you've got, in an example here, one stock that has a cost basis of $1,000. Got 10 shares, cost basis of $1,000, and those 10 shares have risen in value to $2,000. And if you decided to sell those 10 shares yourself with that $1,000 of gains, and assuming you're in the long-term capital gains tax bracket and you're in the 15% rate, well, the $1,000 of gains would equate to $150 of tax. And after the sale and after taxes, well, you wouldn't have $2,000, you would have $1,850. Instead, you could just take those 10 shares worth $2,000 and gift them, donate them to the charitable organization of your choice. They could sell it, they'd have the $2,000 of cash, and no one would pay any tax. And then to finish off the strategy, if you still had that $2,000 of cash in the bank, you could invest that into your investment portfolio, rebuy those 10 shares, reestablish that higher cost basis, and maintain your overall position in that holding. There are a few considerations to be aware of with this strategy. The first one is that there is an AGI limitation. You can only deduct up to 30% of your AGI for stock donations. And so if your AGI, your adjusted gross income, is $100,000, well, you can only deduct up to $30,000 of stock donations. For cash donations, the limit's a bit higher, it's 60%. Also, you want to make sure that when you're making a stock donation, you're donating stocks that you've held for more than 1 year. If you've held them for less than 1 year, you don't get the full benefit of the full market value as a deduction. You only get to deduct the cost basis of that stock. You slide into getting the whole market value once you've owned that stock for a full year. So 2 things to be aware of when making stock donations. Now let's look at the next strategy, the final strategy in this 2-part session in our 10 for 10 series. And this is funding a donor advised fund. And the strategy of funding a donor advised fund really takes that last strategy of a stock donation and putting it on steroids. The donor advised fund really creates a system of gifting over many, many years. It's a multi-year gifting strategy. And a donor advised fund is really an investment vehicle. It's a fund with the objective to donate to eligible charities. Now, the last strategy works well for one-time gifts. This one works for much larger sums with larger donation plans in mind. Now, a few notes about donor advised funds before we dig into the strategy. First of all contributions to donor advised funds are irrevocable. Once you've placed the money in the donor advised fund, you can't pull it back for your own personal need. Donor advised funds are investment accounts, and with all investment accounts, there will be fees and expenses associated with them. Donor advised funds often require minimum account balances. You typically can't have a small balance in that account. And lastly, if there's money in the donor advised fund after you pass away, that money typically gets distributed to charities that you've listed as beneficiary designations, or your spouse or children can take over and continue the endeavor of giving that money away. And so, getting back to the point of donor advised funds, this is a great vehicle to use to make a significant donation over several years. So if you're thinking of making $10,000 annual donations for roughly 5 years, you could just make that every single year, or in 1 year, make a $50,000 donation into a donor advised fund. That $50,000 donation is the year that you get the deduction. And also, at any point then going forward, you can then make the donations from there. You could do it immediately, or you could parse out $10,000 a year for the next 5 years or so. It's really up to you when you want to make those grants. The $50,000 contribution into the fund is the year in which you get the donation. Of course, donor advised funds can always be funded with cash, but the purpose of this conversation is how to minimize the impact of capital gains tax. And so ideally, it's something like appreciated stock. So, with an example of making a $50,000 donation, if you looked into your portfolio and by chance happened to see an investment or several investments that had a cost basis of $30,000 and a market value of $50,000, that could be the ideal asset to put inside of a donor advised fund. Now, there are 3 different tax planning strategies in motion with donor advised funds. Let's use that same example of a stock holding position that's worth $50,000 and has a cost basis of $30,000. Well, the first tax benefit is in the form of the tax deduction you get if you itemize. It's the year that you make the contribution to the donor advised fund is the year that you get the tax deduction. It's not the gifts that come out of the donor advised fund that count as contributions and deductions on your tax return. It's the year of the big gift. And so if you're making a $50,000 contribution into a donor advised fund, that would count as a $50,000 deduction on your tax return. And so when's a good year to make a large donation into a donor advised fund? Well, it's a year in which you've made a lot of money. If you find yourself in a high tax bracket and you're hunting for tax deductions, this could be the year to make that larger donation to bring down your taxable income. The next strategy is that by placing the highly appreciated stock in the donor advised fund, you've avoided the possibility of paying capital gains tax on that stock. So in that example of a $30,000 cost basis and a $50,000 market value, you've got $20,000 of gains. And assuming these are long-term gains, taxed at 15%, that's a $3,000 capital gains tax bill. So after taxes, it's about $47,000, but pre-tax, it's $50,000 in value. So by placing the stock, the appreciated stock, into the donor advised fund, you've avoided triggering $3,000 of capital gains tax. Now that stock can continue to be held in that fund, or it can be sold and a diversified portfolio can be created. But now you've got that money in motion inside of the donor advised fund. And then the third tax advantage here is that all the future growth from that portfolio or from that stock, from the money inside the donor advised fund, represents additional money that you're able to give, and there are no taxes on the growth of the money inside of the donor advised fund. All the growth inside the donor advised fund happens tax-free. And so the donor advised fund really becomes a mini personal foundation for multi-year giving with many, many tax benefits. And there you have it. those are two more additional strategies for minimizing the impact of capital gains tax. I hope you found this helpful and useful. Stay tuned for session 8, 9, and 10 yet to come. Thank you.